Hi everyone, this is Himanshu Singhal. Today we are starting our series on area by area, and we are discussing on the borings. Boring is in our audit, it is not considered a very important area, and it's a residual area. Now in FDD, it can get quite complex depending on whether the company is stressed and they have complex borings. Particularly post-COVID, there are a lot of stress companies, and they obtain complex boring instrument. Today, we'll start with how to research the borings, and in the subsequent videos, we'll cover the advanced topics. So, what you should do is first you should see which areas of financial statement you should look at. We'll start with the boring section, of course, and therein you need to see where are your short-term borrowings, long-term borrowings, and then you need to see the commentary in the schedule below. Okay, then you'll move to other liabilities or financial liabilities. In there, you will find area items such as interest accrued but not due, interest accrued and due but not paid, and short-term loan classified in these heads. Then other assets like India's adjustment may impact borrowings such as prepaid charges relating to borrowings. Then you need to see the finance cost as well. This whole bouquet will comprise your diligence of borrowing. Now, how will you start? To take control of borrowing, what you should do is you need to create two schedules. First will be on the borrowing. I have presented a simplistic one. I generally get my team to do make similar kind of thing. A subset of this when borrowings are not complex, and a little longer version where the borrowings are more complex. So you'll start with like whether what is the bank names, whether the loans are secured, unsecured, what is the effective rate of interest. Now, effective rate of interest is applicable in those cases where the rates are changing. Okay, for example, the day you took the loan, interest may be 8 to 9%, but since the rates are increasing, your effective rate may be different as on the closing date. Generally, we present the closing rates as if what is the effective rate, and it could be derived from a LIBOR plus percentage plus spread and something. And so you need to obtain the effective rate of interest from the management so that you can present to your investors. Now, then you'll need to have what was the amount sanctioned and what is the amount outstanding as on closing date. It will rarely be seen because amount sanctioned maybe 1,000 crores, and you have been really allowed to withdraw maybe 900 crores, and vice versa is also possible that amount may be 1,000 crores, but you have taken the loan, and as on closing date you might have paid half of it, 75% of it, and a little balance is remaining. So you need to take this balance. You should very peculiarly think about this, that this particular amount outstanding, this should match to your financial statements. Okay, only then you will have a control that whatever borrowings you have taken, they are complete, and there is nothing that you should add here. The complexity that I have faced in here is particularly relating to India's when the processing fees are sometimes reduced from the borrowings, and the actual amount that you're required to pay will not be visible here. So what you'll need to do is you'll need to gross that processing fees and charges to arrive at the what is the amount really payable. In DD, we are not concerned about what books are presenting. In this particular schedule, I would like to present to my investor what is the real amount payable. Now, then you need to see the interest accrued as on date. Now, ideally, this balance is what is the accrued balance as per the financial statements. At this stage, I generally don't prefer to go into like what should be the interest accrued. At this stage, I prefer to keep the number simple, so that we have a control over the borrowings as such. So I take interest accrued as per the balance sheet. Okay. Now these all details can be find out in the financial statements whenever management gives you. You may take help of trial balance, or in a rare circumstance when management give you schedule if you are lucky enough. But in the most of the cases, you will need to apply your mind and derive these balances based on the financial statements, because in financial statement they generally don't give by bank name. You have to go to the trial balance. There you might have like which all banks are there, what type of loans are there. If nothing is there, then obviously you'll have to discuss with management and arrive at these balances. But this is the first step that you need to take to take control of the borrowings. Now the second step would be to go through the agreement. Okay, in the agreement you will find these clauses, for example a security clause, like which items are pledged, then change in control clause, the repayment schedule, some special clauses, and you should also have a confirmation status. Like confirmation status here means that you have been able to check the balance from somewhere. It could be bank statement, screenshot of bank website, or confirmation. But in our practice, we are not we don't usually get the closing balances because we are working on the interim period. For example, I might be doing July DD and September DD, so companies don't usually take confirmation on such a regular frequent basis. So we have to go through the alternate methods. We may take some screenshot of bank website or something. Anything you have to do is the focus here would be if you can certify that this much is amount outstanding from somewhere. Okay, that is the objective here. Now, if we speak about what you need to see in the agreement, so I have broadly written down certain items that I generally prefer my team to have a look at, and they would have seen and have a good understanding of them, so that we can incorporate our understanding in the summary above. Okay, so generally people read the agreements on a high level, and juniors prepare the summary. But in case of complex agreement, I would suggest that you yourself prepare the summary, because the terms are very complex, and you may want to read them through. Okay. So what should be your focus while studying an agreement? You should see why the loan was taken. Like it could be, for example, for repayment of old loans, or fresh loan, or capex, or working capital. Generally, this thing is given in the first para of sanction letter, which you just habitual of ignoring. But read through it carefully. It will help you understand why was the loan taken, and may help you in your reviews and to answer a client. Now, the second is, when was this loan taken and what are the terms of repayment? Repayments could be like bullet repayment, in one go you are paying everything. Then there could be monthly interest payout plus some principal. The principal could be fixed, varied over schedule of the loan, or it could be fixed EMI. Then even post-COVID, the moratorium has also started in many loans. So you may find the moratorium clauses as well. Moratorium is basically that when you defer your loan and interest payout and everything, and your loan repayment start at a later date. This concept is like very old, but it was more known to normal public when the COVID started. Now, then you'll need to see what type of covenants are there. And when they're due for checking. For example, they should be checked at an annual date like March, or there could be certain cutoff date after which they will be checked. So financial covenants could be depending on profitability or your asset ratios. We'll cover that separately in a video. What are the covenants? But you need to check what covenants we have and when they are due for checking. Now, interest rate. Interest rate generally you won't get fixed interest rates like 8%, 10%, or whatever. In most of the companies, you'll find it's a benchmark plus a spread, maybe LIBOR, Eurobor, something plus spread of 2%, 3%, depending on your arrangement or negotiation with the bankers. Then but if you happen to find fixed loan rate interest, those will be at a higher rate. And only when the company is really stressed, they go for the higher rate of interest loans. A very important clause then comes is event of default. What you should see is what is the event of default and what will happen when this default happens. So generally there is a long list of defaults ranging from standard one, which are more relevant to legal, but your financial one, it includes your loan interest repayments on time or satisfaction of covenants, or there could be other events also. Now you need to see what will happen in case your defaults happen. Like the two potential scenarios would be either you can obtain simple waiver or waiver from the bank, or you need to immediately repay the loan. Second one will be more severe, but banks generally keep the agreement open, like they can forego or give waiver on their own, or they may ask you to make the repayment. This is a very important clause to highlight in case your loans are not getting paid on time. Now, what you'll additionally see is the security clause. Okay, so security are generally like fixed assets, and then what your client really want to know in this is, what are my assets that are pledged? Plus, are there any securities or shares that are pledged? Because that's what the investor is buying. They are buying the shares, and if those shares are pledged with bank, you can't really own them. And it's a very important observation for your client. So make sure the note of it. Now, for the second schedule, you will make the finance cost. Finance cost, in audit, it is more relevant because you try to recompute and try to match whether there is adequate accrual. But in here with us also, it is a very important schedule. So I have listed down effective a sample here. So in this, first is the bank name, then the effective rate of interest, how much amount is for financial. This all is information is given by the management or in the financial statements. Now here your work starts. Your work is recomputation. Recomputation is simple. You have a loan and the interest rate and what is the period you're computing on, and you can very easily compute the interest. In addition, in FDD, what you are required to do in this particular schedule is you need to capture the interest accrued moment. Okay, so for example, interest accrued as per financial statements will take by loan again here. Then you the recomputed interest by you. Then your shortage of interest accrued. Now this shortage of interest accrued will go to your net debt table. Yeah, so this is your brief overview of borrowings, and we discussed like this is how you start and make two schedules and read agreements so that you have a basic level of control on the borrowings. In our subsequent video, we'll discuss more about type of loans and other advanced topics. Thank you very much for watching. Please do like and subscribe.